Many investors' portfolios are perfectly positioned for the outcomes of the past, when the future will surely be different. Current asset allocations represent a portfolio that may have been justified decades ago when U.S. stocks made up over 70% of world market cap and Treasury rates actually outpaced the rate of inflation. Today, U.S. companies represent less than half of the world's market cap, and Treasury yields after inflation are negative and are pushing up against the limitations of zero yields. The old model, 60% domestic equities and 40% high-grade bonds, does not address the opportunities and risks investors face today. We need a new 60-40, one that is more globalized, more diversified, and more nimble. The new refocused 60% is a globalized equity allocation that combines shares of large companies in developed markets, including the U.S., that can tap global growth through diversified revenue streams, and positions in emerging markets and global small-cap stocks, which offer potential diversification and growth benefits. The new 40% goes beyond traditional fixed income allocations and includes increased exposure to high-yield investments like high-yield bonds and senior loans that pay well above inflation and which might keep pace with inflation. This can be tempered if needed with a buffer of U.S. government bonds in a credit barbell that combined can offer a higher yield than traditional core bond portfolios while keeping aggregate default risk moderate. Next, exposure to international bonds in an attempt to maximize positive real yield potential and diversify currency exposure. Finally, a range of alternative assets like commodities, gold, REITs, currencies, and non-traditional fixed income securities like senior loans to serve as specific provisions for inflation and other risks. It's time to rethink investment allocations. The traditional 60-40 no longer reflects the opportunities in the world, nor will it provide the benefits it once did. It's time for a new 60-40.